Okay, so let's knock out this chapter 8. Not quite as intense, certainly not as intense as chapter 6. Probably not quite as intense either as chapter 7. The last part of this, we want to talk about what are called flow-through entities. These are, I had mentioned in the last lecture a little bit about what these are. These are things like partnerships, S corporations, trusts, I think estates as well will oftentimes kind of fall into this category. So these are entities that they have to report their income and expenses, and they have a separate tax form to do so, but they don't actually pay income tax at the entity level. These are entities that are owned by others, and they may be owned by other individuals, might be owned by partnerships, might be owned by other corporations, might be owned by other trusts. So there can be multiple levels here of income that's flowing through or passing through. I guess they're calling it flow through. We also use the term pass through. That income that then ultimately passes through to the individual tax return. So they're special in that regard. They don't pay tax, so there's no like partnership tax rate or anything like that. If with a partnership, the owners of the partnership will pay tax on their share of the income at whatever their income tax rate is. So, for example, if you've got a partnership, oh, I don't like this one. It's almost like a Sharpie. Hopefully this one works. Yeah. So if you have a partnership that has, let's say, 3 partners, partner 1, partner 2, and partner 3. And each of these partnerships, according to the partnership agreement, owns a certain percentage of the partnership. When we talk about partnerships, we'll talk about how that percentage is determined and what makes up, how it is that partners can become partners in partnerships. There are different ways they can contribute money, they can contribute property, they can contribute services to the partnership, but they each ultimately have some partnership ownership, and it's based on a percentage. So if we say partner 1 maybe is a 50% owner, partner 2 is a 25% owner, and partner 3 is a 25% owner. So altogether we have 100% of the partnership, but it's owned in these proportions. What happens is the partnership will put together its tax return, record its income and expenses, and then its net income, kind of like a sole proprietor does, a sole proprietorship does. So same types of income, same rules for the income, same rules for depreciation, same rules for the expenses, so ordinary and necessary expenses. What happens is then our net income gets allocated to each of these partners based on their ownership percentage. So if we have income, net income, and think of the Schedule C and what constitutes net income on the Schedule C. It's items that are related to the generation, to what that business does, right? It's not things like interest and dividends and capital gains. It is, what did you sell? What did you make and sell? Or what service did you sell? And what were the expenses against creating that income, right? It has to do with the business purpose of it. So net income for the partnership is kind of the same. Whatever the partnership does. If they make widgets, it's their income from making widgets. If they're a CPA firm, it's the net income from providing those services to their clients, right? Like I said, it's not other types of income. It's not like rental income. It wouldn't include rental income, wouldn't include dividend income or interest income or any of those things, even though the partnership may have that type of income. And what happens is the different types of income they flow through, all of them flow through to the owner, but they flow through in different ways. So they're reported in different ways. So let's just say for this partnership, they had net income of $100,000 in that year. That does not mean that these partners actually received any cash from the partnership. It just means that the partnership reported net income of $100,000 that's taxable to each of these partners. So partner 1 is going to report $50,000, partner 2 $25,000, partner 3 $25,000. And each of those partners then is going to pay tax on that income at their own individual tax rates. So if this partner is in, let's say they're in the 22% bracket, so tax bracket, they're in the 22% tax bracket. This partner is in the, 24% tax bracket. This partner is in the 37% tax bracket that this income is taxed at. They're going to pay, even though it's the same income coming from the same partnership, they're going to pay different amounts of tax because it's based on their own individual tax brackets. So obviously, these individuals have other sources of income as well. Maybe they have jobs. Maybe this one's a CEO of some large company and they're making, $700,000 a year, but they also own part of this partnership. So what happens is this gets reported to each individual and they will pay tax at their individual tax rate. So if you look, come on. So the tax that this individual would pay, $11,000. So 6,000. And then this individual, whoops, 9250. So you see partner 2 and partner 3, they reported the same income, but because they're in different tax brackets, that same income from that same entity is going to be taxed at different rates for each of them. This is what the flow-through entities are. And in this chapter, what we want to talk about is how that income is reported to the partner, reported by the partner. Like what do each of these partners do to report that income on their own individual tax return? When we get to chapter 14, we're going to talk about how the partnership reports the income on their tax return. But for our purposes right now, what we want to do is focus on how does the individual who has the ownership in this partnership, how do they report the income on their return? So we have these mentioned that this income here would be from operations, like from whatever it is that the business does. That's how the income is generated. But partnerships can also have other sources of income. The partnership could own property that it rents out and have rental income. The partnership could invest in stocks and bonds that they then generates capital gains or dividend income. So what happens is this income here from operations gets reported as ordinary income to each individual partner. And then we have these things called separately stated items. Everything else, every other individual piece of income, interest income, dividend income, capital gain income, rental income, all of that also gets allocated to each partner, but it's going to be reported separately because, as we've seen, those pieces of income get reported differently on the individual tax return. So we have kind of two separate categories of income. We have ordinary income, and then we have these separately stated items. And the separately stated items may be income, they may be deductions. So the 179 deduction, if the partnership took the 179 deduction, each individual partner, remember there were limits to how much each individual could take on the 179 deduction. Well, if one partner hasn't taken 179 deduction on anything else, but the other partner has already exceeded their 179 deduction, well, now we've got to figure out what we've got to state those items separately because it's going to be treated differently for each partner. Okay, so and that's essentially what they're saying here. So they have to supply. They do this. They have to supply each partner or shareholder or owner with what's called a Schedule K-1. A K-1 is like a W-2, like a 1099. It reports income. But the K-1 is very specific about separating out the different types of income so that then the partner is going to report that income separately on their own tax return. So here, let's see. What else do we want to say? As they mentioned here, so partnerships can be passive. Like you could just put money into a partnership as like an investment, and then the income from the partnership is going to be treated like investment income to the partner. But a lot of partnerships, the partners actually are actively involved in the partnership. And so what that means is those partners, like this income, you think of it like a sole proprietorship. It's like a sole proprietorship, but with more than one person. So that means this income is going to be subject to self-employment tax as well. Because if it was a sole proprietorship, like if partner one was on their own and they earned $50,000 of this kind of income as a sole proprietorship, they would be subject to self-employment tax. Same thing for each of these partners. So income from partnerships to the partners is subject to self-employment tax as well. Now, certain types of corporations called S corporations are this weird hybrid between partnerships and corporations, and they have some special rules with regard to owners who receive, who provide services to them. So what I'm talking about here, just partnerships. Okay, when we get to the last chapter, chapter 15 on corporations, we'll talk about what some of those special rules are. So the ordinary income from a partnership also is entitled to that qualified business income deduction, what we talked about in chapter 6. Because like I said, it's essentially like a sole proprietorship, but it's owned by multiple people. So all those same rules apply, and all of the same benefits to a sole proprietorship are also applied to the partnership. So as it mentions here, so I do want to read this part because this talks about the why we separate out those different types of income. So why are the different types of income and expenses that flow through from a partnership, such as ordinary income, interest, dividends, royalties, capital gains, charitable contributions, 179 expense deductions, etc., separately stated? Why not just lump it all together and have one income or loss number from the partnership? Well, because any item that could be treated differently by different partners is separately stated. Also, partners and partnerships could be corporations. Corporations have special tax rules and they have special tax rates. So if that corporation has flow-through income, it's going to treat that income a little bit differently. So these items are separately stated because the item could be treated differently from partner to partner. For example, one individual partner might have capital gains from other sources to offset capital losses from the partnership. Think about that. We just went through the chapter on capital gains and losses. We talked about the netting of capital gains and losses. If you have a capital gain from an individual investment, and then you also have a partnership, and that partnership has a capital loss, you can use your portion of the loss from that partnership to offset the gains that you have individually. But other partners may not have those gains. They may not have, it's going to be treated differently for each individual partner. Whereas another individual partner might not have any capital gains and be limited in the amount of capital losses that they're allowed. Another example concerns a corporate partner who receives a dividends received deduction. We'll talk about what that is when we get to chapter 15. And no deduction for capital losses. Individual partner would have to include the dividends in income, but could also deduct up to $3,000 of the net capital losses. We already talked about those rules. Additionally, for an individual taxpayer, most charitable deductions are limited to 60% of AGI. So if the partnership made charitable contributions, and only each of these partners is going to get to claim their share of those charitable contributions. If partner 1 itemizes their deductions, they'll get to claim those charitable contributions up to the individual limits. Maybe partner 2 and partner 3, they don't itemize their deductions. And so they're not going to get to take advantage of their share of the charitable contribution. The limit occurs at the individual level and could result in a different income depending on the individual partner's particular situation. So this is kind of a list of the different separately stated items that could be coming from a partnership or from one of those flow-through entities. So we've got our ordinary income and where it's reported on the individual tax return. So ordinary income is going to be reported. I'll show you where that's reported, the ordinary income. It ends up on the Schedule 1 other income, which then flows through to the 1040. But it's initially reported on the Schedule E. And I'll show you where that it's on page 2 of the Schedule E. Dividend income from the partnership is just going to be reported with other dividend income. If you have to fill out a Schedule B, then it's going to show up on the Schedule B. Short-term capital gains, long-term capital gains, all that stuff's going to flow through and be put on the Schedule D. Charitable contributions would show up on the schedule, would be entered on the Schedule A. The 179 expense is going to show up on the 4562, just like the other 179 expense that we may have. Earnings from self-employment, again, we're going to have to pay self-employment tax on our earnings from the partnership because it's considered to be self-employment, so that we're going to have to fill out the Schedule SE for that. Those separately stated items are items the partnership does not deduct or include in income, but each partner's share is reported directly to the partner. Same as if it were a sole proprietorship. There's no place on the Schedule C for capital gains income. There's no place on the Schedule C for dividend or interest income. All of that stuff is separately stated on the individual tax return if you have a Schedule C. So the same thing applies to a partnership. So let's see if I might come back to that. This is the form that is sent to each individual partner. This is part of the partnership return. This is called Form K1. So just like a 1099 would report different types of income, this reports income, ordinary income, and separately stated items from the partnership, and it is in the proportion of the partner's ownership. So it's each individual partner receives one of these, and then they report this ordinary business income. They report that on the Schedule E, page 2, but all of these other items get reported elsewhere on their individual tax return. So rental and real estate income, that's going to go on page 1 of the Schedule E, as we learned where other rental income goes. I'll talk about guaranteed payments here in a second. Interest income, that's just going to go on the Schedule B or directly on the first page of the 1040. Ordinary dividends, same thing. You can see we've got ordinary dividends and qualified dividends. We've got those separated out. So those qualified dividends would qualify for special treatment, special tax treatment. Royalties, again, that would go on page 1. So if something shows up on like this net short-term capital gain or loss, that's just going to go on the Schedule D under all the other short-term capital gains or losses. They've already done the netting here, but then at the individual level, it's still going to be netted again with the individual's own tax, other tax items. Section 179 deductions. So this is the portion of the Section 179 deduction that the partnership took that belongs to this individual partner. You can see the name of the partners here, Jose Ramirez. He is a general partner, which means he provides services to the partnership. Domestic partner, so if he was a foreign partner, that would be indicated. This is his percentage of ownership. So he owns 40% of this partnership, which means he has to report 40% of the income, and he gets 40% of the other separately stated items. I think this is probably a charitable contribution that the partnership made it, but this 40% of it is Jose's portion of the charity. That's what he gets to report. There's another area here for distributions. So like I said, the partner reports this income and pays tax on it, but that does not mean that they actually received any cash. They receive cash when they get a distribution. So if they didn't receive any cash, they're going to have to come up with the tax money to pay to pay on the income. A lot of times what will happen is the partnerships will give the partners at least enough money to pay the tax, and that would be through a distribution. It's kind of like, so the partnership, kind of like an investment that they put money into and they pay tax on it, and then if they take something out, that's going to lower their basis in the partnership, but then they'll get the cash so that they can pay the tax on it. So this is what the K-1 looks like. The guaranteed payments. So line 4 of the K-1 is where guaranteed payments are provided. So there are, if a partner receives, now partners don't receive a W-2, but if they provide services to the partnership can pay them for those services. But the payment for those services, or as you can see here, payment for capital or payment for services, gets reported separately. It doesn't get reported on a W-2 or a 1099. It gets reported on the K-1. The partner pays tax on that amount in addition to the ordinary income. They're going to pay tax and self-employment tax on both amounts because this guaranteed payment was a separate payment and it reduced the ordinary income overall. So if they paid Jose $30,000 a year because Jose provided services to the partnership, that $30,000 acts as a deduction, a deductible expense, which reduces ordinary income. So he's going to get the benefit of that reduction up here, but he received $30,000 of payments for services. So he's going to turn around and pay tax then, and pay self-employment tax on that amount of the guaranteed payment. We'll get into that in more detail in chapter 14 as well. So this is a good kind of preliminary, a little preview. No, don't do that. A little preview of chapter 14 here. Let me see, is there anything else? Two pieces of information. What's the other piece? Partner is not an employee of the partnership, thus cannot have a deductible salary to the partnership. but the partner can receive a guaranteed payment, which is deductible to the partnership, but then the partner has to pay tax on it, because a guaranteed payment is not salary. The partnership does not pay Social Security tax or Medicare tax. They're not the employer in that situation, so it's treated like self-employment income. What else do we want to say here? Is unimportant for the. So that's what and the partner has to worry about that, not the partnership. Okay, so there's the K1. So for this flow-through entity, you can see they've got the things that would be reported on the Schedule E, page 2, would be the ordinary business income or loss and the Section 179 deduction. All of those other items are going to be reported elsewhere on the tax return. Again, the capital gains and losses are going to be reported on Schedule D. The dividends are going to be reported on Schedule B or directly on the tax return if they don't have to file a Schedule B. The $2,000 charitable contribution is going to be reported on the Schedule A if this partner is itemizing their deductions, but the ordinary income or loss and the 179 deduction, that's what's going to be reported on page 2 of the Schedule E, and I'll show you how that gets entered in. So here's page 2 of the Schedule E, and it says income or loss from partnerships and S corporations. Very first part. There's another part down here for income or loss from estates and trusts. So if it's an estate or a trust, it would be listed there. So column A, here, or row A, we've got the name of the partnership. Enter a P for partnership or an S for S corporation. This is a partnership, so we're going to put a P there. It's not a foreign partnership, so we don't have to check that. The employer identification number of the partnership, which is listed on the K1. Nothing there. So there's no passive loss from there. There's no passive income from the K1. This is not a passive ownership. What you would enter on for this K1, here is the 179 expense. This gets entered on the 4562, and then it also gets entered onto this form here. So this helps to offset other income on the return. And then there's our non-passive income. So this is our ordinary income, that 2130. Look at the K1, 2130. And then the 179 deduction, there's 7600 there. That goes here. That's a subtraction from it. And then I don't know why that's not a negative, but that should be in parentheses because we're subtracting. So they get to take a loss, a $5,470 loss against other income because that's what they had for this partnership. That's the only thing that gets filled out really on page 2 of the Schedule E. The income from all other flow-through entities is not considered a self-employment income like a partnership. So S corporations flow-through income is not considered self-employment income, only the partnerships. We're not, passive activities, we don't go through chapter 13 very much. We don't go through chapter 13 at all in this class. I figured you got enough information to keep in your brains without also adding passive income losses. But passive activity is an activity in which the taxpayer does not materially participate in the operation. So it's just an investment, essentially. Investment is often a passive activity. Actual trade or business is considered active. So active trade or business is going to be subject to self-employment tax. Passive activity is not going to be subject to self-employment tax. So any passive activity, even though you get the benefit of not having any self-employment tax, but there are limits on the losses that you can use to offset other income. Whereas with an active trader business, you can offset that income from other income on the tax return. Let's see. So the passive rules. So if it's a limited partner on a K1, so let's look at the K1. I'll show you where that would show up. Limited partner. If it was just a passive partner, that box would be checked, that box would not be checked. That's what distinguishes between the two types of income. That would mean that the income on this would not be subject to self-employment tax at this point. If it's checked, or if there's income from rental activities, the activity is likely a passive activity. Passive rules require that the taxpayer categorize income and losses into three types: active, passive, and portfolio. Generally speaking, taxpayers can deduct passive losses to the extent that there is passive income. So you can only deduct up to that passive income, so no net loss would be allowed. Any excess losses cannot be used to offset active or portfolio income, but they're carried forward instead to offset passive income in future years. In the case of a rental activity, taxpayers allowed up to $25,000 of rental losses, subject to phase out, AGI phase outs, which I think is like $150,000 for married filing jointly. They talk about those limitations in Chapter 3. So, things I want you to take away from this for this particular chapter is like that distinction between the ordinary income and separately stated items, and the reason behind that, why we're going to report that separately, because it's different types of income. Just like we report wages on a W-2. We report interest income on a 1099 INT. We report dividend income on a 1099 DIV. We report rental income on a 1099 miscellaneous. So each of those types of income has their own form. This has it's one form, but all of those types of income are separated out. Okay, so sort of the same concept there. And I want you to take away the fact that with a flow-through entity, each partner is going to report their share of the income and expenses based on their ownership percentage in the partnership. Okay? Questions?